You ever stop to ask yourself how the wealthy just continue to build and grow that wealth? The secret lies in the wealth management strategies that they possess. And in today's video, we're going to be going through and unveiling 8 of the top strategies that we see to build wealth and to continue building true wealth. Starting with number 1, understanding your financial goal. This is really the pivotal part. What do you want to do with your money and how are you going to achieve it? This could include some goals such as saving for retirement, buying a house, starting a business, whatever it is, you have to have a measurable goal that is achievable with a set time frame. The more clarity that you can put around this objective, the better you can tailor the strategies to reaching that objective. Write it down with the goal in mind, starting with a plan, and I really recommend putting it down on paper. Everyone's financial journey is going to be unique, but starting it off with one solid good step will really set you in pace and on the road to financial freedom. Now, number 2, we look at the diversified portfolio. This again is something that is huge. Not putting all of your eggs into one basket, not putting everything in all your investments into one single thing. This could include stocks, bonds, real estate, investments in gold. We know gold has a really good return. It could be collectibles. There are a ton of popular things that you could have that not only have high liquidity, but can also hedge against some of the things that we see as of today, which are the trigger points, including inflation, economic instability, and currency fluctuation. Now, of course, there's a lot of wealth in investments that don't go the best way, but a lot of them where if gold is up, some of the other things might be down. If the market is down, bonds could be up. This really doesn't rely on a single strategy, which is going to be kind of a one and done. This is a powerful wealth management tool that you can mix into your investments when you start growing it, which really will align with those financial goals, but also allow you to mitigate the risk tolerance. Now, number 3, risk management. This again is something you cannot avoid risk. If you don't want to take risk altogether, you're never going to grow wealth to the point that you need to. Instead, understanding and making decisions based on potential rewards, potential risk, and what the rewards or the returns could be. There's a very wide world of tools and techniques out there, from diversification, asset allocation, hedging, and more. Remember, investing, and when it comes to long-term wealth, it is a long-term game. Majority of people didn't get wealthy overnight, short of hitting the lotto, but when you're putting money away into a 401k, into IRAs, into an investment accounts, into HSAs, into a diversified portfolio, it is going to be kind of crazy. Now, one thing to remember with this is keeping emotion out of the game. When the markets are up, it's no different. If the markets are down, you're sticking to your plan. If they're up or down, this will ensure that your wealth strategy stays on track, even if things get bumpy. And right now, looking at the news as of today, it is pretty crazy with everything that they're talking about inflation. Of course, the market had a couple bad days. That's a good buying opportunity when it's down a couple percent if you're looking to make those regular investments. Number 4, we get into regular reviewing your financial plan. That is right. Regular review, just like we do with our budget, at least once a month or once every couple months, will allow the strategy to really work and make any adjustments if you're not on track to those financial goals. This will keep them not only front of mind, but it will also make sure that you're within reach and that you are going to and moving towards that exact same goal. Now, perhaps it is a job promotion to increase your investment contributions. If it's an unexpected life event, this is the time where you kind of reassess not only the risk tolerance, but also is there additional need for changing up the financial plan? If you were single when you started this and now you have a spouse or a significant other, now you can change up the financial plan. If you have kids in the future, going to be the exact same. There are going to be things that are going to adjust and change your financial plan as you're going through life. Now, remember, the wealth management strategies that you set are not these set it and forget it strategies that we once know. It is a very dynamic journey. And again, this is very, very unique to the individual that is creating the plan and exactly what they do want to do. Number 5, we look at the tax efficiency investment plan. That is right. When it comes to taxes and the tax mitigation, any way that you can remove and reduce that tax liability, it seems super complex, but actually at the very core, it is very easy. For me personally, hiring a qualified tax advisor to really see where we can kind of cut some of the funds, making sure certain investments are taxed differently, the short-term capital gains, the long-term, understanding the distinction of where the money is at, what taxes you can get, but also remembering all of the tax advantage accounts that we have to overall mitigate the tax burden that you have. This could include your 401ks, your IRAs, your HSAs. Now, a lot of those, of course, when you look at high income generations like bonds, could put it and be into tax deferred or tax free accounts. However, some of the index funds could go into taxable or non-taxable accounts, again, depending on what you have it invested in. Now, number 6, the power of compounding. This is something that I feel a lot of people overlook. If you've seen the video we did yesterday, putting away $200 a month, meaning $2,600 a year over 28 years, will give you 1.1, just north of $1.1 million. So in the course of, let's say you start working at 20, at the age of 48, you can have 1.1 million in the account with a very low $2,600 a year investment, which is kind of crazy because even thinking of a contribution as you start getting a little bit further with the regular contributions, you can grow and amass wealth like no other, especially again, if you're 48, you're 58, now you're looking at 60 plus, you're retiring, you're looking at almost $3 to $4 million depending on your contribution, which is crazy. The longer your money is invested, the more time it has to grow and the more time it has to take care of the compounding interest. Like a tree that grows from the seed, it is gradually going to be small at first and then get absolutely massive when you start compounding. This is the reason why Warren Buffett, a majority of the wealth with the compounding factor, was achieved after the age of 60. Now, of course, the compounding means that you don't want to touch these accounts. If they're retirement accounts, if they're investment accounts, depending on what your plan is, you want to make sure that you're not borrowing against them, which is what we see a lot of times. The 401ks get dipped in for first-time home buyers that are used as unsecured loans. A lot of people do borrow money against those 401ks, which can really be detrimental when it comes to the tax advantage accounts and also detrimental when it comes to that compounding factor. Number 7, prioritize retirement planning. There is never enough funds to maintain and enough funds to have to retirement. If an estimated right now from Charles Schwab is $1.8 million in a retirement account to retire comfortably. They are not even saying, having a real healthy, happy retirement. They're talking because people are living longer, that they need roughly 1.8 million is the new kind of tagline from Charles Schwab that people do need to make sure they retire on track. Now, of course, taking full contributions of matching funds, making sure, again, utilizing those 401ks and those IRAs, and also diversifying the portfolio in this manner through the retirement planning with the risk and returns. Remember, retirement planning is a marathon. It is not a sprint. You are not going to compound money overnight. It is going to take a multitude of years based on the growth factor that you have. And the final one is incorporating philanthropy into your day-to-day. Not only the money strategy, but also the ability to help your community, help people that can use some help. Looking at education, looking at healthcare, direct donations can be given to a lot of different churches that can go to charities. And also it has a really big positive benefit when you think of yourself. And some of the charities, depending if they're registered, might also be a tax benefit, meaning if you're making larger donations to them, you could see in paying less taxes overall because of those. And it will be a very powerful way and a positive impact to manage some of the wealth that you have created. So covering the top 8 wealth management strategies for every investor that you need to know. Let me know in the comments what you guys think, and thank you guys for watching.